Ladies and gentlemen, good evening and welcome to HDFC Bank earnings call on the financial result for the quarter and year ended 31st March 2018, presented by Mr. Paresh Sukthankar, Deputy Managing Director, and Mr. Shashi Jagdishan, Chief Financial Officer. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the brief commentary by the management. In case you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sukthankar. Thank you, and over to you, sir.
Thank you. Good evening, everyone, and first of all, apologies for having to start a little later. By the time we got the results in a machine-readable format uploaded and so on, it took a few minutes, but we had indicated that we might start at 5:15. So without much ado, let me read out some of the key financial data parameters, and then we'll be happy to take questions thereafter. So as you're aware, the Board of Directors approved the bank's quarterly and full year results at the meeting held today. The accounts, of course, have been audited. For the quarter ended March 31st, the bank's total income was 25,549.7 crores. This was up from 21,560.7 crores for the quarter ended March 2017. Net revenues increased by 19.1% to 14,886.3 crores. Net interest income was at 10,657 crores, which grew by 17.7% over the 9,055 crores for the quarter ended March 17. Average asset growth was 16.9%. The core net interest margin for the quarter was 4.3%. Other income was 28% of net revenues. So net interest income was 72%. So other income at 28.4% of net revenues grew by 22.7% over the and touched 4,228 crores for this quarter, over 3,446 crores for the corresponding quarter of the previous year. There are four major elements in the other income. Commissions, which is the largest piece, accounted for 3,329 crores out of the total 4,228 crores. So fees and commissions grew by 32%. FX and derivative revenues were 416 crores, grew by 16.7%. The profit and loss on sale of investments or bond gains and losses, there was a loss of 22 crores as against a gain of 180 crores in the corresponding quarter of last year. And the recoveries and miscellaneous income was at 504 crores as against 386 crores for the corresponding quarter of last year. So once again, the total other income grew by 22.7% to 4,228.6 crores. Moving on to the expenses, operating expenses for the quarter were 6,050.6 crores, and these increased by 15.9% over the corresponding quarter of the previous year. The core cost-to-income ratio, therefore, was at 40.6% as against 42.4% for the corresponding quarter of the previous year, of March 2017. Total provisions were 1,541 crores as against 1,261.8 crores for the corresponding quarter of last year. If you look at the breakup of those provisions, 1,132 crores were specific loan loss provisions, and general provisions were at 153 crores, and other provisions, including contingent provisions, were at 255 crores. After providing for taxation, the bank earned a net profit for the quarter of 4,799.3 crores, which was an increase of 20.3% over the corresponding quarter of the previous year. For the full year, for the year ended March 31st, 2018, the total income earned was 95,461 crores. Net revenues were 55,315 crores, up 21.7%. The core NIM for the full year was 4.3. The core cost to income ratio for the full year was 41.7%, and the full year net profit was 17,486 crores, up 20.2% over the year ended March 2017. Total balance sheet size touched 10,63,000 crores. This is up from 8,63,000 crores in March 2017. Total deposits were 7,88,000 crores, up 22.5%. Savings account deposits at 2,23,000 crores were up 15.6%. Time deposits were up 4,45,000 crores. They were up 33%. So CASA ratio was at 43.5% as of 31st of March 2018. Advances at 6,58,000 crores increased by 18.7% over the previous year. Both wholesale and retail have grown, and the mix now is about 57% retail and 43% wholesale. On the Basel II classification basis, the retail loan growth was 27% and the wholesale loan growth was 9.4%. On the capital adequacy, the bank's total CAR ratio, as per Basel III guidelines, was at 14.8%. This compares with 14.6% as of March 2017, and as against the regulatory requirement of 10.875%, which includes the capital conservation buffer of 1.875. So 9 is the basic CAR requirement plus the CCB of 1.875. That makes it 10.875 as a requirement, and we are at 14.8% as against that. The Tier 1 capital adequacy ratio was at 13.2%. That's as against 12.8% in March last year. The CET1, Common Equity Tier 1 capital ratio, was at 12.2%. The Board of Directors recommended a dividend of rupees 13 per share of for per equity share of rupees 2, as against 11 per equity share of rupees 2 for the previous year. This, of course, would be subject to approval by the shareholders at the next AGM. On the network side, we closed the year with 4,787 banking outlets. These were across 2,691 cities. We also have 12,635 ATMs, and 53% of the total banking outlets are in semi-urban and rural areas. The total employee strength went up from 84,325 employees in March 2017 to 88,253 employees as of March 2018. On the asset quality front, gross NPAs were at 1.3% as on March 31st, 2018. This is as against 1.29% in December 2017 and 1.05% as of March 2017. Net non-performing loans were at 0.4%. As of March 31st, the bank was holding floating provisions of 1,451 crores. A word or two on our subsidiaries. As you know, we have two subsidiaries, HDFC Securities Limited, which is amongst the leading retail broking firms in India, and the bank holds a 97.7% stake in HSL, for the year ended March 2018, HSL's total income grew by 42% to 788 crores. Net profit for the year was 344 crores, which was a growth of 59.5% over the 215.9 crores in the previous year. On HDB, which is a non-deposit taking NBFC, which offers a wide range of loan and asset finance products to individuals, emerging businesses and micro enterprises. Again, the bank holds 95.9% in HDB Financial Services. As of March 2018, HDB's balance sheet size was at 44,754 crores. The total loan book grew by 34.9% to 43,573 crores. Their net interest income grew by 36.9%. The net profit for the year was 951.7 crores, which registered a growth of 39.1% over March 2017. Gross NPAs for HDB were at 1.6%, net NPAs were at 1%, and their total CAR was at 17.9%, and Tier 1 CAR was at 13.2%. Finally, the consolidated net profit for the year ended March 31st, 2018 was 18,510 crores, up 21.4% over March 2017. Consolidated advances grew by 19.6%. They touched 7 lakh crores as of March 2018. I think I've pretty much walked you through almost all the financial data a little more in detail, since maybe some of you might not have received or might have received the press release only as the call was starting. So I took that additional time to read this out, but we'll be happy to take questions now.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Maru Kadachania from IDFC. Please go ahead.
Hi, Paresh.
Hi, Maru.
Just wanted to, could you share the number of slippages for the fourth quarter?
Sure. Yeah, it's 1.7%.
Oh.
You want the absolute number or just the percentage?
Absolute number.
Okay. It's 2,790 crores.
Thank you. And my second question is that, with so many banks now being under PCA plus the PNB scam, the corporate, the growth opportunity in corporate loans is even getting bigger. So would you like to grow your corporate loan book at a faster pace, or how do you view this opportunity? Anyway, there has been a traction in your corporate loan growth, but from here on.
So, I think
there's a base effect.
Yeah, the corporate loan growth has been, fairly healthy. If it looks a little muted for March over March, it's because March 2017, actually that quarter we had seen a very sharp spike in corporate loan growth. But to your point, are there opportunities to gain market share in corporate? In that, actually, I would say wholesale, which includes corporate, the middle market, and SME. The answer is yes. That's been something we've been doing, and we remain focused on it. I don't think I wouldn't say that only tactically issues which are currently being faced are the only reason. I think we are focused on gaining share based on what we believe we are offering in terms of product range, turnaround times, the technology and digital backing of our products. So yes, I think we'll remain focused on growing our wholesale book within our risk appetite.
How is the agri asset quality now stabilizing, or there's still an issue with waivers and stuff like that?
Yeah, I don't think we can say that the agri piece is completely settled yet. Typically because these dues come up every alternate quarter because of the crop loan cycles. And yes, there are other issues which impact asset quality beyond just the farmers' cash flows. Whether it is issues like what you mentioned in terms of potential waiver promises or anything of that sort. So I think this is a portfolio which still we sort of remain focused on growing, but in a cautious manner.
Thanks a lot. Thanks.
Thank you. The next question is from the line of Manish Oswal from Nirmal Bang. Please go ahead.
Yes, sir. Thank you for the opportunity. My question on the balance sheet growth in this quarter, there is some mismatch in terms of our total deposit growth and loan book growth on quarter-to-quarter basis. Secondly, term deposit also grew 13%, whereas our loan book growth only 4.3%. So can you throw some light why there is a mismatch in that kind of growth rate?
Yeah, actually, if you look at the previous couple of quarters, loan growth had sort of sped a little ahead of deposit growth, and we had seen that deposit growth was lagging loan growth in both the September and December quarters. So we did want to step on the accelerator a little in terms of getting more deposit flow in, which is what we have done. I mean, if you now look at not just the sequential growth in a particular quarter, but if you look at the total deposit and the loan growth, you'll find that we are very comfortably funded, but our loan to deposit ratios are still in a range which is sustainable. So from our perspective, we still continue to look at pacing both our loan and deposit growth on an annualized basis at somewhat similar growth rates. And of course, to try and maintain a healthy mix of those deposits as we get them. So you're absolutely right that in this last quarter, there was a bit of a catch-up in fixed deposit growth, which had been lagging in the previous couple of quarters.
Second, sir, employee expenses growth has been quite muted over the last few quarters, and why employee addition such a slow pace, or digital banking making reduction of roles or jobs? How do you see in employee cost trend over next few years?
So I would say not just from an employee cost trend point of view, but from an overall OPEX perspective, the move towards increased digitization, both in terms of proportion of transactions which are moving to digital channels, as well as our sales, credit and operations processes, especially on the retail lending side. Clearly, both of those are helping improve our productivity and cost efficiencies. And as a result, therefore, you have seen in the last 4 or 5 years, in baby steps, the cost to income ratio has continued to improve. It's coming down. Having said that, because the bank has been growing very substantially, and we continue to increase our presence in some of the semi-urban and rural areas, and there are some other segments and initiatives that we keep driving, the total number of employees, of course, has grown this year. It was again a little muted last year, but in fact it had come down last year from the previous year, and now it's back again at a slightly higher level than where it was in March 2017. So if at all we've got an increase in staffing, it's because of purely increased growth requirements, even after the scale that we have achieved, even after the improved productivity and efficiencies that come from digital and other process re-engineering.
And in this particular year, sir, when I compared the fee income growth over the last couple of years, this year the growth is very strong, 30% on a full year basis. So, is there on a full year basis? Is there any large one-off in the total fee income? And secondly, how do you see the sustainability of this growth rate?
So you're right that this year, I mean, from a couple of years of roughly mid-teen growth, this year we've seen most fee lines growing, somewhere in the mid-20s or sometimes even higher. And the three areas where we did see a pickup in fee growth in the last year has been third-party products, both mutual funds and insurance. Retail asset fees as the retail loan book continued to grow, and credit cards, of course, again because of a continued growth in terms of both card issuances and spends.
Yeah, especially after demonetization, we've seen a large shift to credit card spends, both debit and credit card spends. So that has also helped us to have a higher income growth from the transactional side of credit cards.
Of course, within the other income, given the increase in bond yields in this quarter, there is a small negative on the bond yield side, but the fees and commissions and FX revenues have done reasonably well. To your question, is there any large one-off? No, there may be some small one-offs here and there, but there was no large one-off which distorted it too much. But and therefore, if there were a couple of % growth which could have been accounted for by some one-offs here and there, it would still have been a fairly healthy growth for this year, somewhere in the mid-20s or thereabouts.
And very quickly, two comments on one is capital raise update and the second listing of any subsidiary in near term. Thanks a lot.
Well, on the capital raise, after the shareholder approvals, we are awaiting the government approvals. So that's the next step, and till that time there would be no further visibility or roadmap that we can lay down. So at this point of time, we are still awaiting the approvals, and at this point of time, there is no immediate plan as far as the subsidiaries are concerned in terms of capital raising.
Thank you so much, sir, for answering my question. Thank you.
Most welcome.
Thank you. The next question is from the line of Kunal Shah from Edelweiss Securities. Please go ahead.
Yeah. Again, touching upon this deposit base, so now what would be the proportion of the retail and wholesale? And if you look at this 13% sequential growth, whether it's more of a wholesale deposit, short-term deposit, or it's still the retail one which has led to this entire growth?
So in this last quarter, we have seen a good pickup in retail deposit growth as well, and of course wholesale. But I'll tell you the mix of our fixed deposits. The fact that in this quarter deposit rates moved up a little certainly has helped the sentiment for fixed deposits. I think two things happened. Perhaps the increase in bond yields perhaps meant that some of the savers who were investing in bond funds or debt funds might have figured that, or might have preferred moving to bank deposits. And so you did see fixed deposits gaining interest again with retail savers, and that was further sort of given a nudge by the increase in fixed deposit rates. So as of March, this is the low in March.
No, this is the total position.
Okay, so as of March, the total retail component of our fixed deposits is 73%.
And how much would that be in Q3, December?
About 77%.
Okay, so from 77, it is up to 73.
Yeah.
So how do we see, so larger part of this piece would also have come in towards the end of the quarter. And overall, when we look at even on the advances side, so obviously the CD ratio has contracted to around about 83 odd %. So how should we look upon this in terms of the overall margin for Q1 and going forward? So would there be like the lag impact which we could see through because of the deposits as well as maybe moving towards the better rated profile on the asset side?
So to be honest, I wouldn't say that the deposit growth in this quarter was largely rear-ended. We've seen pretty healthy deposit growth through every single month in the quarter, in fact. But on NIMs, whether it's a result of what's happening on the deposit and deposit costs and loan yields, or the mix of loans, or generally the market environment. I think, we sort of stay with the fact, while we don't have a specific guidance on a number, traditionally we've remained in this range of about 4.1 to 4.3 or something like that. And I think all of these potential impacts will probably keep us in that range. So within that range, we can see a movement in both directions from quarter to quarter, depending on how the environment is and the liquidity position in the environment is. But I don't see us being outside that 4.1 to 4.3 or perhaps a 4 to 4.4 range, at least in the near future.
Okay. And in terms of the advances, so obviously the advance growth, particularly on the corporate side, given the opportunity which is there, that has still been, say, lower. So how are we looking at it in terms of maybe PSU banks not being active? What would be our strategy out there? Are we looking at the businesses, and in fact that should have led to the better growth in this quarter and in coming quarters as well? Or maybe we are holding on to as of now because of the increased competition which would be there. So how are we playing this entire space as of now?
So clearly on the retail side, we are a market leader. A lot of these products are doing well. We continue to grow that, building on our brand, our distribution, our product range, our technology, digital, the customer experience. And to be fair, on the retail side, since there aren't there aren't too many other banks who've been of significant size, the market share gains probably are a little lesser on the retail side. Our growth is more linked to the underlying markets or the underlying demand for those products still being fairly healthy. On the wholesale side, as I mentioned earlier as well, between the large corporate, the emerging corporates, and what we call business banking, there is a good momentum. It still remains a credit environment that one needs to sort of be careful about. But within our credit appetite, there are opportunities, and we are tapping into those. This is across each of the three segments that I mentioned. Given that loan yields have been somewhat muted, given the competition levels, and the fact that good credits are getting rates which, at least for a while, were not in line with the kind of growth that had happened on the deposit rate side. We've been growing, but we grow that within our appetite and at the right rates. So we do see in this year as well, both wholesale and retail growing in not very different growth rates, and we believe we are equally well positioned in both these. Some of that growth is obviously coming depending on what the competitive environment is.
Also, Paresh did allude to at the beginning of the conversation that there was effect. March 17, in the quarter of March 17, we did see a bit of a spike in our loan accumulation. We added as a bank 60,000 crores. So if you adjust for some of the base effect there, I think the growth is pretty healthy, even on the wholesale side.
Okay. And lastly, in terms of slippages, any impact of RBI's revised framework on our overall slippage number of 2,800 crores?
No, not during this quarter.
Oh, okay. Yeah. Thank you.
Thank you.
Thank you. The next question is from the line of Suresh Ganapathy from Macquarie Capital Securities. Please go ahead.
Yeah, hi. Most of my questions have been answered. Just I wanted to know what is the logic behind you requiring a government approval for capital raising? I mean, as long as we do incremental capital raising also in 74-26% format, why should you require a government approval?
No, so raising, since the total capital raising that we have got crosses 5,000 crores. For total foreign capital raising crosses 5,000 crores, we do need approval. In fact, what used to be while the FIPB doesn't exist anymore, there is an equivalent approval from the parent, from the parent ministry. and then CCTA approval.
And the Cabinet Committee of Economic Affairs.
So there are legal approvals which are required for us to raise.
So for anyone who raises more than 5,000 crores, foreign capital?
Yes.
I guess that's...
So there was, for a while, there was no limit. The limit has been put in, I think, about 6 months ago.
Oh, okay. Fine, that's clear. Thank you so much.
You're welcome.
Thank you. The next question is from the line of Sameer Visser from JM Financial. Please go ahead.
Yeah, hi. Thanks for the opportunity. Can you talk about competitive intensity in some of our retail products, maybe CVs or for that matter even the unsecured products?
So clearly, competitive intensity in most retail products has increased because I guess many banks who traditionally were not so active on retail, perhaps from the rebound from the wholesale business for them not growing as fast, or maybe because they just are now looking to grow their retail books more than they had in the past. There are a few more players, and those players who've been around have been looking to increase their share. So it's been competitive both from a rate perspective, from a payout perspective. Obviously, to the extent that we are well positioned, given the fact that we've probably been one of the few players who's been consistently in this space, has a market leadership, and has constantly been evolving in terms of our offerings, the turnaround time that we deliver on our digital platforms and so on. We've been able to maintain and in an odd case even increase our market share. But from a pricing perspective, it still remains fairly competitive. And if there are smaller pockets where we find that the rates have become, or the risk reward or the rates themselves or the payouts are not don't sort of seem to make sense for us, we've decided that the marginal business is not something which we would look to tap into. But those are small pieces. For the larger part, I think we still see a strong opportunity to grow across the entire range of retail loan products. Mind you, these numbers are muted to the extent that in the last couple of quarters, we've not taken too much of our home loan origination. In fact, we have taken none of our home loan origination in the last 2 quarters because we were seeking some clarifications and so on some issues
on the
GST and some other issues. So, but once that is resolved, we'll start taking what we have originated back. So our origination engine still remains strong and ticking away, but the actual retail asset growth on the books is muted to the extent of a couple of quarters of retail loans that we have originated, but we haven't bought back.
Okay. And just quickly, any strategic update on the HDB Financial Services, from what products the growth has come from or where it is heading from a medium-term perspective?
Well, the logic of HDB has been very clear that they are in many of the products that we do. However, they access a customer segment that the bank does not access, right? So they are clearly more in these segments which as an NBFC they are comfortable accessing. So they come in at a slightly different rate and risk segment. Their growth has come actually from a range of products. They have grown the commercial vehicle and construction equipment business. They have grown business loans. They have grown LAP. So it's really a wide product range across 3 or 4 retail products. Many of these are products that we would do at a different price point. And from a medium-term perspective, we still believe that there is a large opportunity for them to continue to grow. They today do have a fairly healthy distribution themselves.
About 1,000 distribution.
About 1,160 outlets. So 1,165 to be precise. So there is a we believe a good runway for them to continue to grow.
Thanks a lot. That's helpful. Thank you.
Thank you. The next question is from the line of Ravi Kant Bhatt from Emkay Global. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just require one quick clarification. The mention of 500 billion, capital or through a mix of perpetual or AT1 bonds and infrastructure bonds. If I recall correctly, even last year you had this item on the agenda for the AGM. So I believe this is a enabling resolution.
That is absolutely correct. That's absolutely correct. There's a requirement for us to take shareholder approvals, which typically I think are valid for a year, right?
Yes, these are valid.
So which is why we need to, within that, the actual amounts that we raise tend to be smaller. But since these are enabling shareholder approvals, we take what we believe is, going to be more than enough for us to be raising there. Last year, of course, we did ultimately within that limit that we got approved, raise some AT1 bonds and in tier 2 and infra bonds and so on. Clearly, this 50,000 is the shareholder approval that we are seeking.
Sure. And if you could just shed some more light on what your thinking is, since we have mentioned infrastructure bonds, so what's the bank's thinking over there? What kind of growth you would want to have if at all you start looking at it?
So, the infra bonds, are just called infra bonds. As you know, they are the only senior bonds that banks are allowed to raise. And we can raise them to the extent of our infra portfolio and our affordable housing portfolio. So actually, a larger portion of the portfolio which becomes eligible for us to raise these bonds against tends to be our affordable housing portfolio, which is part of what we originate and then we buy back from HDFC. But separately, as far as the infra opportunity is concerned, in specific segments and for customers that we've been dealing with, we have seen a growth there. Again, it's not a large portion of our portfolio, but selectively we do have the appetite to grow, and we've been tapping into those opportunities even in the last few quarters.
Sure, that answers my questions. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Ravi Naredi from Naredi Investments. Please go ahead.
Hello.
Ravi, your line is muted.
Yes, sir. So much cash withdrawing from banks now, and there are a long queue. Are you getting good deposits?
Well, frankly, the deposit growth has more to do with, has little to do with cash demand or cash withdrawals. If anything, the queues that one sees are really a function of perhaps the increased demand for cash. But I don't think the cash, queues and ATM queues have really have any relationship or direct relationship with the deposit growth at all. Okay. If you go back to the demonetization day, that was a different issue. As you know, people had to deposit cash in all their currency which was demonetized, and that led to a spike in deposit growth. But this is just normal, currency which is being sort of withdrawn for whatever use by customers.
So no, there is the news from banks, new regulation finance minister has imposed that the low persons are fearing and they are withdrawing deposits. And
I don't think because that's something which has been speculated about long back. I think in the recent past, none of that is we haven't sort of got any of that as feedback.
And one more thing, now the cash is more in compared to pre-demon level. So can you tell what is going on about excess cash requirement and anything? Can you tell something what is going on?
Honestly, at a system level, it's tough for us to try and conjecture that. All I can say is that in our own experience, the digital transactions from the pre-demonetization time to now have gone up very sharply.
Yeah, but that is the thing. But cash requirement is now too much that we can't think what is going on. That's the important point. That's why I'm asking you, because you are a good banker and you can tell what is going on. That's why I'm asking you.
I think, I'm sure there are, if we have 5 of us, we'll have 7 opinions on that. But to be honest, everybody is groping in the dark about, where or, the total cash levels. It is a fact that the numbers seem to indicate that the total currency in circulation seems to be back to at or above where it was pre. But then
Right.
it's been a couple of years, so the total the economy and therefore the amounts would have also gone up. But honestly, I think I have no specific knowledge or data which I can.
Okay. Thank you.
Right.
Okay.
Thank you. The next question is from the line of Nilanjan Karfa from Jefferies. Please go ahead.
Hi, Paresh. Good evening. A couple of data points. First of all, I think we did add some floating provision this quarter. Is that correct?
No.
I think 1326 odd crores, right? Last quarter, December quarter.
So there would have been reversals, right?
So there, if you recall, there are whatever we created in the third quarter comes back on a particular account. That provision has come back to floating provision. And also, way back, there was another government account where we were asked to provide standard provision.
Correct.
That has also come back. One portion of that has come back this quarter into floating provisions.
So it's really a reversal of where the floating had been utilized in the past various quarters.
Right.
Those have been reversed. They have been put back into floating.
Okay. And any policy that we have in place right now, as to how much high this number could be?
So I think there is a board-approved policy, but it's more to do with our assessment of various portfolios and where we see something specific in terms of the outlook for our portfolio and the environment. But there is no numerical sort of policy that we are or number that we are trying to guide to, or that we think we should target in terms of basis points for floating. Again, I think as we move to Ind AS, all of these provisions will sort of all tend to converge into what the requirements will be under that. So I think this whole thing of specific, general, and floating and so on is really a current gap issue, which will get morphed into slightly different types of provisioning, if you might, under Ind AS.
Absolutely.
Sure. And can I have the movement of gross NPL between addition, cash recovery, write-offs, etc.?
Sure. So
for the quarter.
The additions during the quarter were 2,790 crores.
Mm-hmm.
The reductions were 2,417, which these are the breakups of those, right?
Yes.
So which amounted to 807 crores of upgradations, 723 crores of write-offs, and 888 crores of recoveries.
Right. Okay. And are we carrying any security receipts? I think last year, I think it was some 220 odd crores. What would be that number this time?
They might have, I think they're very marginally run off, but they are roughly in the same range.
Right. And are we carrying any 525 accounts? Because I think we also had a similar number last year.
So I don't think there is any incremental 525 which are now remaining. No.
Okay. And then last qualitative questions on specifically on SME and further drill down into exporters. Have we witnessed any improvement in those categories in terms of their underlying turnover, volumes, etc.?
In some segments of SME, we've seen a bit of a bounce back after the initial impact which they went through post the transitional phase of GST. They've obviously found their bearings, and we've seen some of them bouncing back. On the exporters per se, we really haven't found any, we haven't experienced anything which is meaningful in terms of a trend. I mean, I'm sure there are pockets of exporters who are doing better and some who are, doing as well or as badly as they were. So, but from our point of view, SME is an area that we've been growing across what we call business banking and even what we call emerging enterprises group, which is even smaller than the business banking segment. And this is a segment which has, of course, risks associated with with them. But we do find overall that our existing customers are seeing some growth, and there are opportunities to add new customers in this segment as well.
Okay, and have you fundamentally speaking, are you going into areas which you in the past did not lend to? For example, could be electrical segment or something like that, because of better availability of data. Has that really been happening?
No, so I think that will take a little more time. So I think if you're talking about the unorganized players coming into the organized player sector a little more, or better availability of transactional and other data, I mean, do we have policies or product programs which can leverage those sort of ready? The answer is yes. But has that started moving the needle in terms of new origination, which is solely or largely based on that? Not yet. But we are still hopeful that that will help, and we certainly have worked on how we need to rely on those numbers to add to the richness of the data that we might have.
Sure. That's great, Paresh. Thank you so much.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit a question to one per participant. Thank you. The next question is from the line of Krishnan ASV from SBI Cap Securities. Please go ahead.
Yeah, hi. Two questions from my side. Number one, the SME 1+2 portfolio, which could become eligible for resolution plans, your wholesale portfolio, how has that been behaving? Say over the last 12 months, have you seen significant improvement in that book?
Actually, it's been fairly stable. We of course these numbers are not in the public domain, so I'm not going to comment on specifics. Yeah. But while we've had a little bit of fluctuation, from quarter to quarter, if I look at it over the last 3-4 quarters, it's been fairly stable actually.
Okay, got it. Number two, HDB Financial Services, the NBFC, obviously, it caters to a certain customer class that HDFC Bank doesn't look at. Have you seen significant, migration of customers from HDB towards HDFC Bank? Does that happen fairly frequently?
No, I doubt whether that will happen. Clearly, to take an example, if there is a customer who's willing to pay, say, 10% or 11% for a particular loan, that customer is, and for the same product, if let's say the bank is charging 9%, reality is that the bank customer is not going to pay the HDB rate, and the HDB customer is unlikely to meet the credit screens, which would qualify him for a 9% loan. So there really isn't. These are fairly distinct customer segments. So if at all, you can say that some of the products are common or being offered by both the bank and HDB, but clearly they play a larger role in in segments which might not have been able to access bank finance. And this is, I guess, the larger stream of things, right? If you look at it, even on not just for HDB and us, but banks and NBFCs have coexisted, and the market clearly is large enough where each of these financial services players is catering to a particular segment in various products. So we also see this as not a sort of a movement of customers from one to the other or anything. Each of us have a specific customer segment, and there is more than enough opportunity for us to grow in those segments.
Fair enough. Thank you.
Thanks.
Thank you. The next question is from the line of Megha Hiraramani from Pi Square Management. Please go ahead.
Thank you for the opportunity. My question is more on the macro picture. How do you see the credit growth in India going forward for, say, next 2 to 3 years? And also considering the fact that the small finance banks or the NBFCs are now rapidly growing and taking up some piece of the pie in the credit system, how do we see the competition growing and the overall credit growth for the private banking space?
So I guess there are two parts to this. One is the overall system growth between private, public, all the banks, foreign, all the banks in the system. And we've seen that the system loan growth tends to be a little ahead of the nominal GDP growth. So if we do see, a whatever 50, 70, whatever basis points growth in real GDP, and with slightly higher inflation levels expected if we look at the numbers, then nominal GDP growth is likely to be a little ahead of where it was in the last year. And therefore, as against a high single-digit loan growth at a system level, we do believe there's a likelihood of bank system loan growth picking up a little, whether it comes to 11-12% or something in that range. Bank loan growth is also going to be a function of the liquidity in the system overall. Last year, we did see some cannibalization of bank credit to the markets, whether it was commercial paper or bonds, because there was an overhang of excess liquidity in the system. I'm not sure whether you'll see the same level of cannibalization this year, because incrementally, I think the flow of money into some of these segments is lesser than what it was last year, and in fact, bank deposit growth is more likely to pick up. Now, within that overall loan growth for the banking industry, I still believe that there are specific segments and perhaps banks in each of the segments that will gain market share. So I think overall, private sector banks will continue to grow faster than the overall system growth, and that is despite what might happen in terms of NBFCs or any other segment that is growing. As far as we are concerned, we remain sort of positioned to grow a little faster, a few percentage points faster than the industry, and we believe that we would, because we have a diversified book across wholesale and retail, we would continue to gain market share on an overall basis in both deposits and advances. And finally, as far as other newer segments, including small banks and NBFCs and so on, the market is large enough. The level of underpenetration in various loan products is fairly high. So there is a good opportunity for any player who has their strategy worked out and can execute. I think the opportunity exists for them to grow.
Okay, that was a fair explanation. Thank you. That's it from my side.
You're welcome.
Thank you. The next question is from the line of Gautam Jain from GCJ Investment. Please go ahead.
Hello, sir.
Hi.
So I was looking at your breakup of the provision. You made other provision of 255 crore. What is that stand for?
So that includes a couple of pieces, but the larger piece of that is a contingent provision that we have made. This is in relation to a part of the agri portfolio, given the uncertainties that are associated with that. So that's a component of the other provisions.
So that is again form part of the floating provision?
No, floating provisions are different. This is, since it is against a specific identified portfolio, not on a customer by customer basis, but on a specific segment of the portfolio. Those are continued provisions for that.
Okay. Secondly, I was looking at your balance sheet. During this quarter, you raised around 89,000 crore of deposit, and same money has been put into cash and balance with RBI. So can you just make us understand the transaction? I mean.
No. Actually, a large portion of that, because there was a spurt in flows, transactional money flows in the last 1 week of March. And since there were a lot of holidays during that period of time, it was put in a reverse repo. So you had, about 60,000 crores of reverse repo that has been put up, which would be used in the early part of April.
Oh, so it was temporary deposit surge.
Yeah.
Okay. And do you have any other subsidiary company than this HDFC Securities and HDFC Financial Services?
No.
Okay. And sir, your qualitative comments on the fee income going forward and OPEX growth?
We've really, since there are 2-3 components to this, as we have said, we don't have any specific guidance on that. But it's a diversified set of fees, and on the bond gains, in any case, depending on what happens to bond yields, that will play itself out. But I don't have any specific guidance on that.
On the OPEX side?
On the OPEX side, while we've seen good improvement, we still believe there are some opportunities for us to continue to improve on the cost-to-income ratio, in baby steps over the next few years. But I think a major portion of the improvement is what we have already delivered on in the last few years.
Okay. Thanks a lot and all the best.
Thank you.
Thank you. The next question is from the line of Sai Kiran P. from RW Advisors. Please go ahead.
Hi. Thanks a lot for taking up the question. Just one specific thing. Can you just comment on the overall system's liquidity, considering the cash crunch which was widely reported in the media, and also the deposit rates being raised off late by various banks, even some of the large banks, including you? Thanks a lot.
Yeah, so I think the overall liquidity position is, a little tighter than what it was for most of last year. The cash piece, of course, has got less to do with the liquidity. The cash currency is a different issue, but overall liquidity, if you look at, where the banking system is, in terms of the credit deposit ratio and the incremental, and for instance, what is going into LAP and so on. Clearly, there is a slight tightening of the liquidity, which has resulted in the slightly higher deposit rates. And in fact, we've also seen those slightly higher deposit rates, seeping through into, MCLRs in some cases. But I would think that, since the signal has been to move from a accommodative to a neutral stance, I think that was only to be expected. So it's not unexpected, but it has played through.
Thanks. Useful. Thank you very much.
Thank you. I think we started at 5:15 and we finished an hour. Maybe I can take one last question.
Sure. Thank you. The next question is from the line of Rakesh Kumar from Elara Capital. Please go ahead.
Thank you. Just looking at the performance on the deposit front, there is a commendable performance that we have done. So total net deposit increases in this quarter is equal to what we have done in the last 5 quarters. And assuming that if we maintain the LDR going forward, do we anticipate that margin would move up from this level?
No, I think from a deposit and loan growth going forward, we are looking to pace our loan growth to a deposit growth so that we don't sort of remember in the first half of the year, we had raised 81 and some other bonds. So we were sitting on non-deposit liquidity, which was being outlaid. Clearly, we've then had to sort of grow our deposit growth to keep pace with or to catch up with what had been a faster loan growth in the previous couple of quarters. But so there can be some leads and lags from quarter to quarter. But as a principle, we have always believed in matching our loan and deposit growth. As far as impact on margins are concerned, really that's more to do with what our mix of deposit growth is. If we can maintain our CASA ratios somewhere around the 40% level, and if our loan mix does not change too much, then the NIM range which I mentioned of between 4.1 and 4.3 as a broad historical range also remains fairly relevant for the future. So I don't think the deposit growth will necessarily or will directly impact NIM, and that range still holds.
Just last question on the cash recovery front for this quarter, 504 crore. This number looking slightly higher, looking at the previous trend. So where has it come from?
This also includes dividend income that we receive every fourth quarter, the interim dividend from the subsidiaries. So it is recoveries and other miscellaneous income. So the miscellaneous income includes a dividend that we have received both from HDB and HSF.
Okay, so that dividend number would be higher this quarter?
It will be. It's I think in the previous quarter. What are the dividends we have seen? I think it's about 40 crores.
Okay.
Yeah, we received roughly about 160 crores. I think it's about 40 crores higher than last year.
Okay. Thanks. Thanks a lot, sir, and all the best.
Thank you.
Yeah. Thank you.
Thank you.
Yeah.
Ladies and gentlemen, due to time constraints, that was our last question. I now hand the conference over to Mr. Suptankar for closing comments. Thank you, and over to you, sir.
Thank you. Thank you, first of all, for joining this call on a Saturday late evening. Of course, Saturdays are working days for commercial banks other than second and fourth, so for us it's a normal day, but thank you for taking the time to be on this call. If I was to look at this quarter, as you've seen, there's been fairly healthy growth across various balance sheet and P&L parameters. Margins have been stable, asset quality has been fairly healthy. So it's really across various parameters been a fairly stable and healthy quarter. And I think we do remain well positioned as we enter this financial year. Thank you once again, and we'll end the call here.
Thank you very much. Ladies and gentlemen, on behalf of HDFC Bank Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.